Markets in turmoil. That's the headline on CNBC this morning. We'll talk about what happens now after the Fed hiked rates 75 basis points. That's coming up on 3 Minutes on Markets and Money. Yesterday, the markets rallied despite the fact that the Fed hiked 75 basis points. That was kind of widely expected by the time we got to the meeting yesterday. And the markets kind of responded initially to the rate hike, but pulled back a bit after some of the announcements by Jerome Powell talking about the economy still strong, everything is fine, but going to be more aggressive about hiking rates over the next several meetings. That took some of the wind out of the rally yesterday. However, overnight, market participants kind of sobered up a bit and realized that a series of 75 basis point rate hikes or more is certainly not a good positive foundation for stronger economic markets. This morning, markets opening sharply lower. We're going to take out this little recent support we put in the last day or so. Importantly, markets are going to be 3 standard deviations oversold. So we're going to be extreme oversold this morning on the markets, and we were trying yesterday to actually trigger a short-term buy signal. That's going to fail this morning as well. So again, that's going to pull back a bit, and we're not going to get that initial kind of rally that we were kind of hoping for. Again, markets are very oversold here, and if we kind of look at the markets, we're in this very defined downtrend in the markets that have been trading between the top of the downtrend and the bottom. We're currently back down here near the bottom of this downtrend. That's going to try to have to hold support today to see if we can at least try to get some type of short-term rally out of this thing over the next few days. Again, markets are very oversold. We should see a little bit of buying in here, just simply investors trying to bottom fish. But the problem is that now with the Fed being much more aggressive, that's putting a lot more downward pressure on prices because earnings estimates still haven't come down yet, and those have to come down first, and that's going to pull valuations as well as we continue to see prices come down. Now earnings coming down, both the P and the E falling. That's going to be a downward pressure that markets are going to struggle with here, at least near term. As we continue to watch this, we're still on sell signals on both of our money flow indicators as well as the MACD. That's again also suggesting lower prices here, at least near term. Doesn't mean that we can't bounce a little bit in the meantime on the way lower, but it does look like we're going to work our way lower over the course of the next few days. So again, use any bounces we get here to help raise some cash, hedge your portfolio, reposition yourself, because again, risk is to the downside momentarily. Now, that will get to an end here at some point, and we're going to get a much better opportunity to get back onto the long side of the markets. But with visibility very limited right now, between the Fed being aggressive, tightening their balance sheet, and again, economic data coming in very rapidly here, if earnings estimates start to be ratcheted down, which they will, that's almost a guarantee here, that's going to lengthen the time that we have to go through this down cycle in markets. So again, be a little bit cautious here, and we'll look for the opportunity for the markets to bottom and take some trading positions in the markets when we get there. That's just not today. I'm Lance Roberts for 3 Minutes of Markets and Money. See you back here tomorrow.